But welcome back, guys. Welcome back. It has been such a long time since we've hosted these WebB Academy spaces. To those of you who are just joining, these WebB Academy spaces tend to be more educational. It's obviously super important that you guys have the right tools to effectively navigate the space, right? And kind of like optimize your strategies in every facet. So we're hosting these spaces quite often, pretty much every week, every Tuesday at around 4 p.m. UTC. But as you guys may or may not know, we've literally been rolling out campaign after campaign after campaign. So we've all been extremely busy. But we're back to it. We're here. We're getting this started. And today we're actually talking about tax optimization with Patrick Camuso. We're so excited about this. I'm going to be honest, to some of you, this may or may not be the most exciting topic, but it is definitely one of the most important if you're serious about staying compliant, staying legal, obviously while optimizing your gains, right? It honestly feels like every year that passes, especially in 2025, the rules continue to get stricter. The IRS gets more and more involved. This space has honestly started to feel like less of like the wild west that we've been experiencing, right? And it's becoming more regulated. Kind of like they're trying to fit crypto into the same mold as like traditional finance, right? So again, guys, today we have an amazing guest, Patrick Camuso, the CEO and founder of Camuso CPA. We are so grateful to have you join us. We will be talking about crypto tax planning, the crypto tax enforcement outlook for 2025, tax planning strategies, optimization, so on and so forth. Patrick, we're so happy to have you, my friend. How are you doing? How's life?
I'm doing great. Thanks for having me. I appreciate it.
Yeah, do you want to tell us a little bit about yourself, about, just give us a kind of like a general consensus of what you do?
Yeah, absolutely. Well, firstly, I want to say, I've been seeing you and the BitcoinOS team at events now for a couple of years, and I think that you guys have a great community, and I'm very pleased to be here with you. A little bit about myself. I own and run a CPA firm called Camuso CPA. We were one of the first crypto CPA firms really, dedicated to serving crypto investors, miners, and Web3 businesses. We've been doing that since 2016. So when it comes to, all the tax issues and accounting issues, I've been through the trenches with this and have, probably seen whatever issue these listeners out here are having with their crypto portfolios or with their company tax planning.
Wow, that's a fantastic intro. Appreciate you diving into that. Yeah, which is exactly like everything that you listed is exactly why I'm super excited for this conversation because it pretty much applies to everybody. Granted, I will say we do have a massive African community here, and so this may or may not necessarily apply to them. So I would love for you to also like later on just like dive into maybe like some international or like global based crypto taxes or just like news that you might be able to share. But first and foremost, I guess let's kind of like just dive into just crypto tax planning. So, um, what changes have you noticed in crypto tax rules this year compared to previous years? Because it's obvious that it's very clear that regulations are tightening. We're seeing a shift towards increased enforcement, more standardized like frameworks, less anonymity in ways. And like I had mentioned before, I think regulators are making it very clear that crypto is kind of like no longer becoming this kind of like or operating in this kind of like gray area of sorts. They're kind of trying to do what they can on their end to bring it in line with traditional finance, right? In so many facets. So again, what changes would you say that you have like noticed that has like shifted year after year?
Definitely. Well, I would say there was some big changes last year in 2024, and I'm also anticipating even more changes in 2025 potentially when new bills get passed related to crypto taxation. So last year, the biggest change is something called Revenue Procedure 2024-28, which basically changed the way that crypto accounting is done in the United States. So for years from 2024 and before that, the accounting was done on what's called a universal basis, meaning we would take an accounting method and apply it on an asset by asset basis, irrespective of where that asset is being held or traded. Moving forward into 2025, it shifted to an account-based reporting system, which means now you apply an accounting method not only to an asset, but to each exchange and wallet. So if you have Bitcoin or if you have Ethereum in 5 different wallets and exchanges, you need to calculate each one of those accounts separately. So that's a huge change that from, what I'm seeing this year, everyone is still behind on, not everyone, but the majority of people are still behind on, and they're still overlooking it. And, that's causes the potential for compliance issues here down the line as we start to see the 1099 DAs coming out this year. And also, it's leaving tax planning opportunities on the table as well, because now that we're under this account-based regime, it does give taxpayers not only more clarity, but also more control if they plan in advance over their tax events, if they properly plan in advance and segregate their cost basis. So I know we'll get into that, but I would say that's probably the biggest change is the revenue procedure that's been implemented. And then there's talks of more changes. We've been seeing around Twitter that there may be some crypto legislation that comes out in the mega bill that Trump's trying to get through right now. Although, we haven't fully seen the details on that yet. There's going to be clarification. People are expecting clarification on things like mining and staking. Wash sales are on the table and other considerations. So there's going to be a lot of changes, I think, this year. But for last year, the biggest change by far is the revenue procedure.
Okay, I got you. And so you're saying we've kind of like shifted into this like account-based system. Like what do you exactly
Yeah.
like mean by that? Like yeah, could you kind of like define like what you mean by that in like layman's terms?
Yeah.
And
So
then
before
yeah, sorry,
Yeah,
go
so
ahead.
like before, sorry, I didn't mean to cut you there. So before, if you had Bitcoin in 10 different wallets and exchanges, and you were trading that, you would just apply FIFO or whatever basis method you were utilizing to Bitcoin, regardless of like what wallet you spent it from or what exchange you traded on. But now from 2025 onwards, it matters where you're transacting in it. So like if you're selling a Bitcoin on Coinbase, that cost basis is going to follow that Bitcoin from whatever wallet it was in previous to that. Or if it was sitting on Coinbase already, the cost basis assigned to that sale is going to be specifically tied to that tax lot. Whereas before, like you could sell something on Coinbase and under the universal method, it would just apply a cost basis assignment based off of the ordering of all your transactions, irrespective of where they're being held. So a few things with that. Like, I guess first, like on the tax planning standpoint, the opportunity is, we're working with a lot of clients right now. You have to get your accounting complete. You have to do your allocations. Once that's done, where the opportunity is on either your accounting method selection and then also your flow of funds and wallet architecture. So if you have Bitcoin that you've been purchasing over the past 5 to 10 years, you're going to have all different cost basis. And once you're clear on your accounting, you could start to segregate those cost basis based off of like what the price is, the acquisition price, into different wallets, and then start to control the tax events associated with them based off of like which wallet you spend or dispose of assets from. So that's the big opportunity with it. Where a lot of people are running into problems though is that number one, they're not caught up on their accounting. At my firm, every single week we're going back 5 to 10 years for people on their crypto accounting. And that's really the first step into getting into compliance with the revenue procedure is getting your crypto accounting up to date. Because the second step is taking your crypto accounting and allocating it to where your crypto is actually held. And then that's basically how you get into compliance with the revenue procedure at like a highly simplified level. So that's usually like the first roadblocks for people are just getting their accounting updated. But once the accounting is updated, it can give you a lot more control over the tax events that are going to take place for you on chain.
Gotcha. Okay. That definitely makes more sense. And so, like, it's obviously super important to be using some like kind of tools to help you like navigate this, like at this point, right? Like you should absolutely be using something to kind of help you navigate. Would you agree?
Oh, absolutely. Yeah, you need to be leveraging an accounting software that's gonna be able to have, the blockchain coverage and data integrity for the types of transactions that you're doing on chain. And there's it's an extremely fragmented market, both at the retail side and at the enterprise and SMB level for accounting softwares for crypto. And none of them are completely plug and play, at least not yet, because they all have this issue of having data integrity to all of the transactions. And there's various reasons for it. But none of them are going to just be like you plug your wallets in and you get an accurate result from them. But with that being said, you absolutely have to leverage them, because that is the first step to doing your accounting, is ingesting the data into the software of choice, and then starting the process of properly reconciling the data. And that's where a lot of people fall into the trap, is that a lot of times they'll take this first step of getting set up on the software and plugging in their wallets, but then they run into the data issues where maybe they're in and out of DeFi protocol and it's not showing the transactions correctly. It's just showing high level inflows and outflows related to that transaction, or they're purchasing an NFT and it's not showing the mint or the purchase price. Or a lot of times there's just data gaps due to their trading history that they need to fill in. So there's all these issues that you're going to run into when you're trying to reconcile those softwares, but you absolutely need to use them and then reconcile them properly. And the biggest key issue that I see people miss is they don't verify their calculated ending holdings. Like, once you use one of these softwares and you do a calculation, you'll have calculated what you're actually holding at the end of the year. One of the simplest due diligence checks that goes overlooked that I can point out here would be comparing the calculated ending holdings on a per asset basis to what you actually have on chain and across exchanges. And that simple step alone, a lot of times, can reveal data inconsistencies and miscategorizations and other related issues with the data integrity. But absolutely, you need to be using one of these softwares, and there's many of them that are available as well.
Yeah, no, I'm definitely in line with all the issues that you mentioned, with there being like so many gaps, because every time I've used those softwares, I'm just like, there's something that's not accurate here. And I honestly do worry on my end. I'm like, if I were to get audited, and if they were to look through like all my transactions, if I were to accidentally like miss something, so definitely super important to make sure that you're
Yeah, yeah.
tracking everything every step of the way, like you said, like to the T with all the numbers. But would you say there's like any forgiveness there? I mean, since we're still kind of in a little bit of a gray area, would you say there's forgiveness if there were mistakes that were to happen?
Um, Look, at the end of the day, in the civil proceeding, you as the taxpayer have to substantiate every position you take on your return. So that means that if you're claiming a cost basis for an asset that you sold, you need to be able to substantiate that, or most likely it's going to be disallowed, and it's going to lead to, you overpaying in taxes. And I see that a lot with tax notices and issues that people are having, where if they didn't properly do their accounting, basically the IRS is going to do it for you and produce a result for you. And if you have ever tried to do your accounting yourself, you know that if you don't do a deep reconciliation, likely your income's going to be overstated, spending is going to be overstated, and capital gains are going to be overstated. And that's a lot of times what we see, is that the IRS calculations are usually not going to be favorable to the taxpayer. And if you want to dispute it, you need to have an accurate calculation yourself with a proper audit trail to be able to substantiate your position. So it's all on a case by case basis, of course. And the issues at hand need to be material to really impact you as a taxpayer. But overall, the responsibility does fall on you. And that's why, making sure that it's really not enough to just like take your wallets, pop them into a software and be like, well, I hope that's good enough. You need to properly be reconciling it and going through it with a fine-tooth comb, because if you do undergo an audit, you need to be able to say where every single tax law and cost basis came from that you're claiming. And also, you need to have all of your deposits and withdrawals traced as well. So, if you're just getting some random crypto deposited into an exchange, you need to trace that back to whatever wallet you deposited it from, which a lot of times when we're going back 5 to 10 years with people, it can be challenging reconstructing that history.
Wow. Yeah. I mean, I appreciate the transparency there. Obviously, a big part of this is doing a big part of like being in the space is doing your due diligence in so many facets, right? And this is a major part of that, especially for those of us who are living in the US. And have to kind of like face these like regulations and such. So yeah, no, I appreciate that. I guess, are there any tools that you would like specifically recommend besides hiring a CPA?
Yeah, so there's so many retail softwares out there and subledgers out there, and I wouldn't want to promote any one over the other. Like, if but I usually tell clients, like, if you're on a software and it's serving your needs in terms of the blockchain coverage, the overall data quality and the reporting that you're being provided, you probably should stick with it, especially if your accounts are reconciled. On the retail side, coin tracking is good. Coinly is widely used. But there's dozens of them on the retail side, and on the Web3 side, there's many different subledgers as well. There's CryptoWorth, Integral. More at the enterprise level, you start to get into Bitwave and Cryptio and those. So on that side too, there's dozens of them. Even CPA firms aren't completely sold on one. At least our firm is software agnostic. We use several different ones, and try to compare like the data quality and stuff like that. But it's more about just knowing that whatever you do choose, you're going to have to reconcile properly. You're going to have to do your due diligence and ensure the accuracy. And also, the other big thing I see is make sure you retain your data. Once everything's done and reconciled, taking a full transaction history to your permanent documentation, along with a detailed ending cost basis report, gain or loss report, all the reports, just downloading that all. A lot of times people will come to us, and the two biggest issues is the prior accounting that was done is inaccurate. Then obviously it has to be reworked. But the other big issue is that they don't have the reporting, either because they didn't save it, or there are some that maybe won't give you like a detailed ending cost basis report and stuff. So you just want to be careful with retaining your data and reconciling it. And there's many options out there in terms of subledgers and accounting softwares that can serve your needs, as long as you're able to navigate those data issues and all that.
Okay. I appreciate all that information. And in terms of like so basically what you're saying is like, just if you find a software that works, stick with that, but obviously retain all your data, make sure that you're tracking everything. But is there any software that you would recommend that has like the most accurate like data collection, would you say?
Um, they're all going to have their issues. I mean, if you're just buying and selling on Coinbase, or like some like standardized transactions on chain, even, like, most of them are going to serve your needs. If you get into more complex activity on chain, or into more obscure blockchains, you're gonna start to run issues, and it starts to become on a case by case basis. I would say on the retail side, I guess coin tracking. But there's many. On the subledger side, it varies much more. We usually take that on a case by case basis with companies, and look at what blockchain coverage do they need, where's their company at in terms of funding, and what are their reporting needs. Because there's even a greater degree of variability on that side.
That's smart, honestly, kind of like diving into each of those companies and looking into what they offer and how they operate. That's definitely something that I've overlooked myself. So I definitely will take that into measure this year for sure. Even though my portfolio is down like 95%, um, I will not be cashing out anytime soon. I'll tell you that much. But yeah, no, I appreciate all that information. And is there any way you could give our listeners kind of like um, just kind of like a rundown of how you should be kind of like operating in this space when it comes to taxes, like step by step instructions, like when you buy some crypto on an exchange, make sure you write that down. When you create like a transaction, or you send it to another wallet, you should write that down. Like, could you give us like a little bit more insight into that?
Definitely, definitely. So, if you're on something like Coinbase, they're going to have good transactions that you could download at the end of the year. And if you're operating on there frequently, you could probably get away with just downloading their reporting like on a quarterly basis. If you're going on like a more obscure exchange that you're not really transacting on that often, when you make your transactions, download the history in that same session that you're having there. That's what I would recommend in terms of just like retaining the exchange data. That's one of the biggest problems that we have when we're reconstructing like 5 to 10 years of accounting for someone. It's like, all right, you were on XYZ exchange 7 years ago and you didn't download the records. Let's see if we can go request it from them, or if it's down, it can cause issues as a taxpayer. So that's the number one thing. It's like always downloading those exchange records, number one. But something like Coinbase, that's going to be available. But still, I would download it on a quarterly basis because you never know if you get locked out of your account or you have something. You always want to make sure you have that, because like any accountants, that's going to be the first thing they ask you for are your exchange records and also your public wallet addresses. So that's the first thing, is your exchange records. The next thing would be keep a good list of your wallet addresses. That is another huge challenge for people, especially when we have to go back and like reconstruct years of the history. There's almost always, once we go through the accounting, wallets we uncover that people forgot about that they had, even exchanges sometimes and stuff too. So keeping a list of your wallets and notating down like what the purpose is for each wallet, the more detailed the better. But at least having a list of your public wallet addresses, what blockchains they're used on, maybe a description on what your activity on that wallet looks like and what the purpose of it is. That's really the starting point, because then at least we have a complete record of your data sources. If you took those steps, right, we'll have all your exchange records, we'll have all your public wallet addresses, we'll know what the purpose of each wallet is, and from there you can start rebuilding your accounting. The next thing that would help is that you do keep contemporaneous documentation related to, it doesn't have to be to every transaction, but like if you're just spot buying BTC on Coinbase, that's going to be self-explanatory. But if you're bridging from one blockchain to another, or if you're like sending crypto to like a family member or a friend, or you're doing something that's more just not going to be clear when we're just looking at it on chain, that's the type of stuff that I really like to see notes from who are our clients on. Now, usually new clients won't have that, and then once we work with you for a while, you'll start to realize the value in it. But I would say like those three things go a long way in like starting an engagement and successfully completing it, because if we have all the data sources and then notes on the obscure transactions, we can start to piece together everything just with that information. Now, when we're usually going through the cleanups, the issues we run into is missing exchange records, missing wallets, unclear transactions that we need to question. So, all those issues would get solved with that. That's really the first step. And then, look, like I said, we're constantly cleaning up years of people's accounting. So, like, I'm sure people that are listening to this are behind on their accounting. We're getting dozens of inquiries to our firm every week about tax notices because, people are getting them because they haven't been reporting. The IRS says there's a 75% non-compliance rate. So there's just this huge issue of like people are not caught up on their accounting. So, that would probably be the next step that I would recommend if you're not, is once you've retained and or compiled all of your data, is you need to get up to date on your accounting. That is the real key to not only compliance, but future tax planning as well. So really, like, that's the next big hurdle for people is, sometimes clearing like a 5 to 10 year cleanup, maybe 2 or 3 years, it all just depends on when you got started. But you're going to need to go back to when you first started transacting in crypto and calculate your cost basis moving forward. Once that's complete and you did your revenue procedure allocations, that's when you could start looking at things more strategically. And it starts with keeping that updated, updating your accounting on a quarterly or monthly basis, making sure you're projecting out any gains and paying your quarterly taxes is like the next base level. And then, with armed with this accurate accounting, you could start looking at loss harvesting and wash sale opportunities. That's kind of like the next base level, I would say. Then from there, we can start looking at how I was talking about before with the revenue procedure changes and this account-based reporting. There's a lot of opportunity there, especially for people that are holding tax lots that have different price points. If you've been in this for a while, you probably are holding BTC, ETH, and other assets at different bases, and you could start to segregate those tax lots out into different wallets and really gain more control over the timing of your capital gains events if you start to be more strategic from that perspective. So, looking at those opportunities with the revenue procedure planning would be the next step. Taking a step back too, it's like, looking at the prior compliance history and making sure like your prior tax filings are good is also very important. Then from there, you start to get into ways where you can tap into liquidity potentially for some of your assets. Looking at loaning against your Bitcoin or other assets can be a good way if you do it strategically and responsibly with risk management. It could be a good way to unlock some of your liquidity without triggering a capital gains event and without losing your exposure to the market. So, that would be the next low hanging fruit. Then from there, we start to get into retirement planning, charitable giving, and then estate planning from there. For if you start to really build up a portfolio and need more trust planning and estate planning for inheritances. And the other thing too would be like staying up to date on regulatory updates. There's going to be a lot of tax changes this year, and they have the potential to impact things such as wash sales and how that's going to apply to crypto and how staking is gonna apply. And these things are sort of being signaled right now, but are still up in the air. And that is something that's just imperative to be staying up to date on as we continue throughout this year, because those can be big changes that are going to also impact everyone. So that's kind of like a high level what I would say. But really it starts with like getting accurate accounting and then keeping it updated. And then you can start taking this forward looking perspective on actually trying to optimize and minimize your taxes legally. But it all starts with that accurate accounting. And also, in addition to that, having it, cleaning up any compliance issues as well. Because we are seeing like a lot of tax notices right now, too.
Wow, thank you so much for that comprehensive overview. So yeah, so basically what you're saying is like make sure that your data is accurate, make sure that you've been tracking it, and then from there you can kind of like start looking into optimizing your tax strategies, while also keeping up to date with like news and regulations and so on and so forth, right? Um,
Exactly.
yeah. So, okay, so that's yeah, that's fantastic. And by the way, just to our listeners as well, there's obviously like a lot of information that's coming in here. As you guys know, we summarize all of these spaces, so there will be a summary of all this information in our Discord after the space. Just letting you guys know, just so that you guys can have it handy. Again, Patrick, this is fantastic, my friend. Like you're just sharing so much valuable information for us. Thank you so much for being here. This is obviously super important, just as important as like, doing your due diligence when it comes to like scam prevention and fraud prevention and stuff in this space. Like it's very prevalent. So this is so much part of like doing your due diligence when it comes to like just optimizing your strategies in this space, right? So thank you again, Patrick. Truly appreciate you joining us today. Um, I guess like some other questions that I had, I also want to give like our listeners a chance to come up and ask some questions. There's already a couple requests, but I did want to ask two things before we do that. First of all, you already kind of like dived into this a little bit, but if you could just dive into it a little further. How is the IRS like actually tracking crypto transactions? Do you know if they're actually tracking it, or is that still kind of like up in the air? Like, how can they have um, absolute certainty over the entirety of an individual's like wallet and transactions, like given the pseudonymous nature of wallets and on-chain transactions and so on and so forth? How can they for sure link it back to that individual?
Yeah. Um, well, firstly, like they don't have to have complete knowledge and necessarily every wallet linked. Most of the time where people are going to run into issues is when they're on ramping and off ramping. And when you do that, it's going to connect whatever wallet you transfer to those exchanges with to your identity as well. So, once they attach an identity to a wallet, then you're gonna, the burden of proof is going to be on you to say whether or not they're your transactions. And when they're getting deposited from that wallet into an exchange, they're either yours or it's income that someone's sending to you, basically, at like high level. So the IRS has been collecting data on crypto for, I mean, as long as I've been a crypto accountant, since 2016, in various forms. And it's just really been evolving, especially over like the last couple years. So, they've done John Doe audits and all these data collections from the exchanges in the past, and there's international agreements like the J5 agreement with other countries like Australia and the UK and others, where like they're all collecting this data over the years and then they all share it together. So there's a lot of that data that the IRS has collected. And now this year there's the 1099 DA that's coming out, which is going to require every exchange to report on every taxpayer that's transacted on their exchange. And what's really interesting about the 1099 DA is that they were actually, when the broker regulations were coming out last year, the proposed broker regulations, they were trying to rope in DeFi with that. So, basically you'd have to get KYC to use something like a Uniswap for them to send you a 1099. Now that didn't get extended to dexes like that in this form of the broker regulations, but that's kind of like the end goal, I would say. But that doesn't really apply right now. Like it's just at the exchange level. But the IRS has all of this data that they're getting from exchanges, and there's people, like I said, we're getting dozens of people every week that are getting tax notices that saying like, hey, we know you have crypto that you haven't reported. We suggest that you report it, more or less. So they're getting tons of people just like with this data collection that they're doing. And then the 1099 DA is going to even increase that more. So that's like how they're doing like the high level enforcement. They're collecting data, they're matching it to what taxpayers are reporting, and then they're sending out different types of notices. There's that soft notice that's saying like, hey, we know you have crypto, you didn't report it, you should report it. And then there's others where they're starting to do their own calculations and say you owe X, Y, or Z amount. And the amounts are almost always overstated because the IRS not having all your information ends up like, once you start doing a capital gain or loss calculation for crypto, you want to have all of your data, or you're going to have gaps in your cost basis that are going to usually lead to you overpaying in taxes. So the IRS, their calculations are usually overstated when they do calculate it. And yeah, I do think that they're going to continue to be gearing up for more enforcement now, for a few reasons. Number one, they're starting to put out like headline cases now. So earlier this year, the Justice Department did their first indictment and conviction for like a pure tax evasion case for someone named Richard Algren III, who basically was buying Bitcoin mostly peer to peer, and didn't report it on his taxes, like 4 million in Bitcoin. and he pled to, I think, 2 years in prison. He had to turn his private keys over to the Justice Department with like 100 million on it. So he's been the first like pure tax case indictment. There's another one going on right now with someone named Waylon Wilcox, who's basically accused of not reporting NFT sales on his tax return. So that one's still pending. So, what I'm seeing is like they're doing these high level cases, and at the ground level, like what we're seeing is that like tons of people are getting notices highlighting the fact that they haven't reported. And the notices are usually right. Like, there's years and years of and millions of dollars of crypto that haven't been reported. So we're seeing that. Also, people like to say like the IRS doesn't have the resources and stuff. As you can see, like a lot of it's just data ingestion and matching, and they also rely on third parties and contractor agreements. So they'll work with some of the major crypto accounting softwares, and they'll collect this taxpayer data, and then it'll get contracted out, and they'll basically do the calculations, present it back to an auditor, and then that's how you'll get this calculated notice. So I don't think this shows any signs of slowing down. I think the 1099 DAs and the revenue procedure last year is a big signal that it's going to continue to pick up, and that the reporting that's going to go out on taxpayers is just going to be even more comprehensive going forward, and then it's just going to lead to more tax notices and just more of the same that we're seeing now.
That's absolutely wild. I also had no idea that the U.S. was actually collaborating with other countries to kind of share data.
Yeah,
That's the first
and
time I'm hearing
they've
that.
been doing that. I mean, that goes back to, I don't know, I would have to look at the exact year, but I remember covering that like probably before 2020. So that's quite some time.
Wow,
Yeah.
wow,
So they have a ton of
wow.
information. If you go on the IRS's website, they'll say themselves that there's a 75% non-compliance rate, meaning they're saying based off of the data that they have, only 25% of people are reporting. So that's their claim, but it's based off of all this data that they've collected. So yeah,
I gotcha. And you were saying that so those two cases that you mentioned, those were two, like, would you consider them like pretty like big, like they're obviously like whales, right? They're big bag holders. Are they doing the same, like in your experience, like for the individuals who are holding like just smaller bags?
um I I'm not exactly sure like exactly how they're doing it, but I would say like most people we're seeing usually have like a good sized portfolio.
Gotcha.
Um,
Okay.
so they're probably cross referencing it with like AGI or like some other data point where yeah the IRS wants to be profitable basically like any business. So they're gonna go after people. I think that they think that there's actually going to be like a tax outcome for them. But it doesn't have to be that huge either because a lot of it's just these data gets matched up and a notice goes out. So I don't think they've been like mass sending them to every like small person that just like bought $100 of Bitcoin or something like that. I think the 1099 DAs are going to push a lot of people to have to report that stuff. They're definitely going after people with sizable portfolios, but it can still vary a lot.
I got you.
Now, something like
And
that indictment with Richard Algren, obviously he was a whale. Yeah, I mean, the guy
right.
underreported like the 4 mil, but I think people reports stated he had like 100 mil in cold storage.
Wow.
So he was,
Wow.
yeah. But now he's sitting in prison because he wanted to underreport 4 million, which is nuts.
Wow. Yeah, that's crazy. That's crazy. Um, I don't know if you can share this information, but with your clients, are you noticing that a letter is being sent out to anybody that has like a that's not holding anything significant?
Well, the other thing I would say, like with our clients that we've had for a while, like they're not really getting notices. It's more like the people that are not reporting for the most part, and like
Gotcha.
they'll come into our firm and be like, I just got this tax notice, like I haven't filed done my crypto for 4 years or whatever it may be. And usually at that point, they want to do it because they're like, they
Mhm.
realize like IRS knows that I have it. Sorry, what was the original question again? I know I went off on a little bit of a tangent there.
No, 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 you answered it. You totally answered it. That makes sense. Obviously, with your clientele, you're not seeing that as much because you know, the people that are coming to you are actually like making an effort to track. Um, so
Yeah, and
that makes
like
sense.
the people that do come that got the notices, they usually have a decent sized portfolio, I would say. But
Okay.
then again, like if someone did have a small one, I don't know if they necessarily would even try to do it with the CPA. They may just try to self manage if it's for like a super small amount. But yeah, like most people, like 500K and above, I would say, portfolio size is usually like what we see. And the high side of that can obviously range greatly.
I got you. And so would you recommend that somebody who, you know, isn't holding anything like significant, maybe under 100K, would you say that they should like regardless of that higher CPA instead of just like resorting to like using software?
Well, I mean, it's just there's just so many moving pieces to this. Yes. It all depends on the person, right? Like if you're just getting started and you have a small portfolio, you're probably better off just starting with a CPA and avoiding all of the issues that we clean up all the time. But it all depends on like how complex their transaction histories are and like what they're doing on chain because you're aware of all these data issues and like the challenges on the
Patrick, did we lose you or did we lose me? Can you guys hear me?
Yes, we can.
Okay, so we must have lost Patrick there. Patrick, you hear us, my friend? Well, I guess we're gonna have to wait for Patrick to come back. That's totally fine. In the meantime, let me sing you guys a song. I'm just kidding. You guys do not want to hear my voice. Yeah, it's kind of rough. I didn't get a good night's rest, so I'm sounding a little rough on my end right now. Let me bring up some of our friends here that are requesting, just so that you're ready to ask some of your questions. In the meantime, while we're waiting for Patrick to come back, actually, let me see if I can pull him back up. Um, yeah, he's definitely rugging. Let's bring up Hank. Let me see here. Yeah, in the meantime, guys, I will tell you since, you know, we've got our community here. We're hosting a community call tomorrow, and I will actually be covering some very important information that you guys have been requesting about for like the last like couple of weeks, which is pre-sale insights. Now I know like about 2 or 3 weeks ago, I already covered like some information, which was the total number of tokens that were sold per stage. What I will actually be covering tomorrow is how much we've raised, as well as the total percentage that we've actually sold from the total supply. You guys have been asking that. As you know, we dedicated about 5% of the total supply towards the pre-sale, towards all pre-sale sales. So I will be covering that exact percentage to you guys. We'll also be diving into charms a little bit as well. I believe Ivan will be there, our charms smith, our favorite charms architect. And then Andrew will also be there. As you guys know, Andrew is our favorite Giga Brain, has all the all the charms information. Let me just try to pull Patrick up again. Yeah, I don't know. I don't know if he's gonna be able to like jump back in. Um, that's okay. That is okay. Yeah. If we can't, if we, if if we end up if he ends up actually like losing connection, I'll just if you guys want to drop your questions in the AMA questions channel, what I can do is I can ask those questions to him later in our Telegram chat. Oh, there he is. You're good. You're good. No worries. Welcome back. Welcome back. What were we talking about? Because I just went off on a random tangent. Do you remember?
I think we were just leaving off on all that enforcement stuff, which
Gotcha.
yeah, I think it's just gonna be increasing here in the future.
Okay.
You'll see more headlines, and we'll be seeing tons of more tax notices.
I got you. Okay. No, awesome. Thank you so much for all that information. And good to know about like the regulations that or the rules that are kind of being associated with like staking and I bet with like airdrops as well, right? Because like that's kind of all like up in the air. So I definitely need to do my due diligence and stay up to date with that. What platform would you recommend for kind of keeping up to date with this information?
Um, Man, there's really not one place. Like, obviously, the IRS is like the source of information, but if you start to follow, crypto tax guys like me and others that are out there, like that's usually going to be like the first place you start to see it on Twitter and places like that. Um, I do cover all of these topics in my newsletter and my podcast too. So if people are looking to get looped into them that way, that could be a good resource. Otherwise, I would say to follow me and other crypto CPAs on Twitter is probably going to be the best place. And then you could start to like take that information and confirm it for yourself through the
Yeah.
proper channels.
Yeah, no, absolutely. That's definitely some good advice. Yeah, everybody here, if you could give Patrick a follow if you want to stay up to date with crypto tax rules, regulations, so on and so forth. He also makes a lot of content on YouTube, right, Patrick?
Yes,
Kind of
yes.
covering this information. So yeah, give Patrick a follow. And then I guess one final question before we kind of like we're kind of getting to an end here. Actually, before I ask that question, I wanted to share today's secret code with the community, and that secret code is when refund. That's WEN refund question mark. And there's obviously a space between those two. So so yeah, go ahead and get those Zeely XP points, guys. And then, final question for you, Patrick, before we go to community questions, but we'll also keep that very minimal because we're kind of coming up to the hour here. Um, what would you say are you've already covered this, but what would you say are some of your favorite like tax optimization strategies? Like, what are some things that I can do? What are some things that we can all do to better optimize our gains?
I think the biggest opportunity right now is looking at your flow of funds and your wallet architecture in light of this account-based reporting. Because I'm helping a lot of people with that right now start to get clear on that, time their tax events in a much more strategic fashion, and it's giving them a lot of control over when those tax events take place. For people that are in a loss position, like the low hanging fruit is to harvest those losses to use them against future gains. And if you're sitting on low cost basis assets that you're in a gain position on, you want to look at the best way to unlock that liquidity, which it could be taking a loan against those assets or timing when the capital gains events take place. So it's somewhat situational to exactly where your portfolio is, but I think really looking at the flow of funds and segregating your tax lots into different wallets is a big one right now that people are overlooking.
Gotcha. Okay. So definitely keeping track of all your transactions, maybe kind of like keeping track of uh like short-term capital gains versus like long-term capital gains, which is like 1 year to and then under. And then what else did you mention there? Just a couple other points so that we
Yeah,
can like
but the,
summarize it.
the bigger thing with the revenue procedure is that like if people haven't made an election on the accounting method, they're all defaulted to FIFO under this. So if you're sitting on like low cost basis BTC or another asset, those early tax lots are going to be the first ones looking at being sold. Whereas if you get your accounting up to date and then you start to look at that basis and where it's sitting, you can start to allocate those to different wallets and then strategically sell the higher basis portions of whatever asset it is that you have. And, you could start to exit some of your position without triggering nearly as large of a capital gains event. So that's a good one just overall for everybody. And then if you are looking to unlock some liquidity, obviously like loaning against your assets is another low hanging fruit. And if you're sitting on losses, harvesting those losses. But the first step is getting clear on your basis, which means the accounting has to get updated, and that is usually a roadblock for most people that we're seeing.
Okay. Yeah, no, that's really good advice, and definitely good mentioning taking a loan out against your crypto as well. Like I don't know if you guys know here as a community, but taking a loan against your assets is not a taxable event. So it's good to it's good for you to like highlight that as well. And then also I was gonna mention, like, I actually had about, I think I lost about like $30,000 four years ago. And what was nice about that, obviously, was there's nothing nice about that, but the positive aspect of that was that the losses that I had kind of like folded into every single year. So I think I took out, I think there was like about 33,000 or $3,500 dollars less that I had to pay in taxes every year as a result of
Mm-hmm.
those losses. So that was beneficial. So definitely, yeah, like you said, optimize on those like losses if you have any. um
Definitely.
yeah, awesome information. I guess so. Community, do you guys have any questions whatsoever? Jason, Indulgent, you guys came up. Hank, you came up. If you have any questions, my friends, put your hands up, and then we will get to your question. Jason, go ahead, my friend.
GM, everyone, GM Aliens, GM Patrick, Indulgent, and everyone on the listener section. Hope everyone is having a great Tuesday. Yeah, I wanted to ask, this question is for Patrick. I wanted to ask, because I'm Nigerian, and let's say I move to the United States and I earn most of everything, I earn all my money from crypto, but then I don't really put any of it in my American bank accounts. Like most of it's usually in crypto wallets or maybe in my Nigerian accounts. Do I still get to like pay taxes? And if I do, how will it be calculated if most of it's in my crypto wallets?
If you're living in the United States and you're making those transactions while you're here, it most likely will have some tax exposure in the US. It'll all depend on what your filing status is in the US though. So that would be the first thing that we would want to get clear on with that.
That's great. Jason, does that answer your question?
All right.
Okay,
Yeah. Um.
go ahead.
Okay. Yeah. I just wanted to say, the code is not working. The secret code you gave us for Zilly, it isn't working, and also if you check
It's
the code,
when,
it's not working for other
WEN
people.
space refund question mark. It should work.
Okay, with
Yeah, with a
question
question
mark.
mark.
Okay, no
Yeah.
problem. Oh, okay, yeah.
All right, Indulgent, you are next, my friend. The mic is yours.
Everyone. So I had like 6 questions lined up.
Oh, nah, no, no,
Luckily,
no.
luckily, Alien got one out. Just got the second one out. So thank you guys for doing me a favor. Um, Patrick, I'm going to try and be really quick with this. I'm going to take them one after the other so I could get like clearance on them. And this is because I have an aunt living in Texas, and it's a big deal because she's into crypto. So, my first question would be, what exactly would they be calculating as earnings on crypto? So let's say I stake certain tokens and get yield from them. Would those be calculated as part of my income? Would airdrops or maybe mining activities be calculated as part of my income, or is it just trading that would be looked at?
You're saying for someone that's a US citizen, right? Or you're saying for
Yes, for someone, yes, who
like your
lives
hand, you're
outside of
saying.
the
Yeah,
US.
yeah. So as it stands right now, yeah, you'd have to calculate income on any airdrops and staking that would establish your cost basis in those assets, and then if you did sell them after that, it would trigger a capital gains event. One thing I'll add is that there may be some changes to how staking is taxed this year, so we'll have to keep an eye out on that. But as it stands now, it would get treated as ordinary income, but then that would also establish your cost basis as well.
All right. Man, you run away from traditional finance, so you come up with the IRS and Web3. It's interesting. Um, I guess my second question is pretty simple. So I know that there are some exchanges that don't work in the US right now. I think from what I've heard you say so far, it's that most of the assets that will be looked at are the ones held in DEXs, most likely wallets, right? But I also heard you say something about this CXs giving information to the IRS over the years. So I would also expect that at some point, they would look at it. So let's say I use a centralized exchange that is not domiciled in the US or not permitted to operate in the US, and I hold my tokens in those exchanges. Is there any fear or any cause to be worried that the IRS will take a look at stuff like that, in the long run?
No, I mean you still need to claim those transactions on your taxes, regardless of where the exchange is located. So, you'll still have to claim them.
Okay,
Was that
so
your question, or was there more to it than that?
yeah, I get you do have to claim transactions, but so let's say I participate in an airdrop event, right? An airdrop event, and that gives me tokens. But I used probably a CX wallet to receive this airdrop, and this particular exchange is not operational in the United States, right? Would, like I said, that's where my question comes from. Would the IRS take a look at stuff like that?
Yeah, you'd still want to report it. Like whether or not the IRS has the information, you should be reporting it as a U.S. taxpayer. So regardless of like if they have your wallet or if they have the exchange data, you want to report it. And what happens is if you get into these calculations and you're selectively reporting different exchanges and wallets, a lot of times there'll end up being gaps in the data, either in the gain or loss reporting and or in the ending calculations, because the data will be incomplete.
Okay, thank you. So the last question is basically, so for the reporting, would the reporting be done cumulatively, or are you reporting transaction by transaction? So let's say every buy, every sell, um, every gift that you get via crypto, whatever it
Everything.
is,
You
are you
got to track
reporting every
everything.
single
You got to track everything. And if there's someone like that hasn't reported in the past 4 years, you got to go back to the earliest transaction and calculate it all going forward.
All right, thank you very much. Those are my questions. Thank you.
Thank you, Indulgent. Appreciate you coming up and asking questions as always. Jason as well. I believe Hank also had a question too. He came up in the speaker role, so I wanted to give him a chance to be able to ask his question too. So Hank, the mic is yours, my friend, and welcome to the speaker panel.
Yeah, so thank you so much for giving me the opportunity. So I just want to say I had dinner with Patrick actually in Bitcoin Vegas. Patrick is a super knowledgeable guy. He's probably one of your best crypto tax guys that you can work with. Patrick, I have a question for you. As I work at a crypto OTC desk, we handle a lot of spot trading, lending, and options. We have recently got clients from UK who are posing problems with lending because they say that if you do any lending solutions and any money kind of like leaves a wallet and goes into another wallet, that gets flagged as it can trigger capital gains. Are you familiar with that?
Well, yeah, there's always a risk that if any transaction going out of a wallet, if it's not traced and noted like what the purpose is of it's for, then if you're undergoing, if like the UK, because that's in the UK. So whatever their tax agency is, the HMRC, I believe it is, when they're scrutinizing that, or when the IRS is, you're going to have to substantiate what the purpose of that withdrawal is. So if you have documentation that, this is for a loan and you're sending it out as collateral, and that's all documented, then I would expect that to be treated as a loan and likely non-taxable. At least in the US, I believe in the UK. But the problem could be like if you're a client's withdrawing crypto out of a wallet and there's no documentation around it. There's no agreement with the lending company. Or the transaction itself is miscategorized and they can't substantiate the purpose of it. Then that could become an issue. So that could be what they're alluding to. I would want to look more into the UK tax side of things. I don't directly work in the UK, but do have some like crypto tax advisors that work over there. We could question it more. But
Yeah.
that's what it sounds like to me, is that they're just considering the documentation side. But if you document it appropriately, I don't believe it should be an issue.
Yeah, I mean, so currently what we're doing at the moment is we're kind of like looking for a solution where there isn't a change of ownership of the collateral under UK law, so there's
Mhm.
no tax implications. Like in particular, it seems that a lot of the loans that come through our desk, we've recently started to see more loans. People are trying to degen a little, trying tax solutions, whatever it is. But yeah, I don't know. Like, it seems that the UK has some specific rules that don't really apply elsewhere. But I was just curious if you knew.
It could be the case. The UK tax side, I'm not an expert in, but I do know a couple crypto focused tax people that are in those jurisdictions. We can definitely discuss it with them further. Because yeah, it may just be some nuance with their tax code.
Yeah, perfect. Okay, Patrick, thank you so much. And thank you
Cool.
for giving me the opportunity to speak.
Awesome. Thank you so much, Hank, for asking that. And thank you for coming up and coming to the speaker panel. I gave you a follow, by the way, just letting you know. Patrick, honestly, we're kind of coming up to that hour mark here. So I know you're super busy. And I also have a lot of things I need to get to today as well. So I don't want to, take up any more of your time. Thank you so much for coming up. Thank you so much for educating us, for sharing such valuable information. I feel like you are genuinely a superhero to the cryptocurrency space, and I don't feel like you get the appreciation that you deserve. I feel like it's a very underappreciated kind of space that you're in, niche that you're in. But just letting you know that we appreciate you so much and really value the information that you've shared with us today. Um, with that, maybe down the line, we can maybe like collab on like some kind of content that we could put out to the community. We're also trying to grow our TikTok as well, just because there's a major cryptocurrency community on TikTok that doesn't necessarily want to be on CT, right? So we're also trying to kind of like cater to that space as well. So maybe we can collaborate on some kind of content, some kind of educational content together. But yeah, thank you again so much, my friend. These conversations are um, extremely valuable, and we just appreciate you so much, as I've been stating over and over since the start of this space. Um, yeah, with that, guys, we are wrapping up. We have a community call tomorrow, as I stated earlier, and we would love to see you all there. Like I said, we're going to be covering some Bitcoin OS pre-sale insights. We'll be diving into Charms again, which is our new programmable chain agnostic token standard. And then we will also be covering the Passport to Freedom campaign, which is pretty much like the ultimate airdrop, right? We're giving away a free passport, guys, literally a citizenship to another country. So we'll be covering more information into that. As always, guys, let's end this space on a good note. And we will catch you guys later.